All right, today we are pulling back the curtain on something that pretty much keeps our entire financial system from falling apart: the Basel Norms. Now, I know it sounds super intimidating, but it's basically the secret rule book that your bank, my bank, all banks have to follow. And trust me, by the end of this, you'll see why this rule book is so incredibly important for keeping your money safe. Let's dive in.
So let's just start with a really basic question. You put your hard-earned money into a bank, right? But what's actually stopping that bank from, I don't know, making a bunch of risky bets and losing it all? What is the safety net that's protecting your savings? Well, the answer to that very question is the whole reason the Basel norms even exist.
To really get it, we need to look at the why. I mean, why do these giant, powerful financial institutions need a global rulebook in the first place? Well, it all comes down to a fundamental risk that is baked right into the way banking works.
You know, the main job of a bank is actually pretty simple. It's a cycle. You put your money in. The bank then lends that money out to someone else. But here's the kicker. What happens if the people who borrowed all that money can't pay it back? That's what we call credit risk. And without some kind of safety net, that one little problem could literally bring the entire bank down.
So what's the fix? Well, banks are required to have some of their own skin in the game. They have to keep a big pile of their own money, what's called their capital, set aside just in case. This capital, it acts like a financial shock absorber. It's a buffer that's there to take the hit when loans go bad, making sure your deposits stay protected. Okay, so if every bank needs one of these shock absorbers, who gets to decide how big it has to be? Who writes the actual rules? Well, it can't just be one country making its own rules, right? For this to work, you need a set of global referees to make sure the playing field is level and safe for everyone.
And here they are, the Basel Committee on Banking Supervision, or BCBS for short. This group was formed way back in 1974, and it's basically the global standard setter. Think of it like a forum where all the major central banks and regulators from around the world get together with one big goal: making the whole international banking system stronger and safer for all of us.
And hey, here's a little fun fact to help you remember the name. The committee's main office is in the city of Basel, Switzerland. And that's it. That's literally why these huge, important global rules are just called the Basel Norms.
Pretty simple, huh?
Now, this rulebook didn't just appear out of thin air. Oh no, it has evolved over decades, and it's gotten a whole lot smarter with each financial crisis we've lived through. So let's take a quick look at how we went from the very first version, Basel I, to the much tougher rules we have today. So there are really three major versions. Basel, I got everything started back in 1988. Then came Basel II in 2004, which made some pretty big updates. And finally, Basel III was rolled out in 2010, and that was a direct response to the massive global financial meltdown of 2008. Let's just quickly break down how this all evolved. So Basel I, back in '88, was really focused on just one thing: credit risk. You know, the risk that someone just won't pay back their loan. Then in 2004, Basel II expanded on that with its famous three pillars: better capital, better supervision by regulators, and more public disclosure. But after the 2008 crisis showed us all the cracks in that system, Basel III came in to make the entire framework way, way more robust. And that brings us to where we are today, with a modern standard, Basel III. Now, this isn't just a small update. It is a complete toolkit designed to build a truly resilient banking system, one that could hopefully withstand the kind of massive shock we saw back in 2008. So this new and improved rulebook really focuses on four crucial areas. First, it strengthens the rules on capital. That's our shock absorber we keep talking about. It also introduces strict limits on leverage, which is just how much a bank can borrow. And it adds brand new requirements for funding and liquidity to make sure banks have stable cash and can pay their bills even during a crisis. Let's take a closer look at these. Okay, let's start with capital. The key number here is the capital adequacy ratio, or CAR. This is the official measurement of that shock absorber. It's a ratio of the bank's capital to its assets, but, and this is the clever part, not all assets are created equal. A loan to a risky startup is, well, riskier than a government bond. So the bank has to hold more capital as a buffer against that riskier loan. Makes sense, right? And this is a really, really important point. Basel III didn't just say, hey, you need a bigger shock absorber. It said, you need a better one. The rules got way stricter about what actually counts as high-quality capital, making sure that buffer is made of really solid stuff that will actually be there when a crisis hits.
Next up is leverage. Basel III brought in a really simple, non-negotiable backstop, the leverage ratio. It basically says a bank's core capital must be at least 3% of its total assets, period. It doesn't matter how safe you think those assets are. This acts as a final safety net to stop banks from just getting way too overextended. And finally, we get to liquidity, which is really just about having enough cash on hand. Basel III created two brilliant new rules for this. The first is the LCR. Think of it like a 30-day emergency fund. It forces banks to have enough easy-to-sell assets to survive a full-blown panic for a month. Then you've got the NSFR, which is more like a one-year stability plan. This one makes sure banks are funding themselves with stable, long-term money, not just risky short-term borrowing.
Okay, I know, we have just gone through a ton of technical stuff. But why should you actually care about any of this? How do these rules that are made in Switzerland affect your local bank and, more importantly, your savings?
This quote really gets to the absolute heart of it. This is an effort to coordinate banking regulations across the globe, with the goal of strengthening the international banking system. It's not just one country doing its own thing, because as we've all seen in our connected world, a banking crisis in one country can become everybody's crisis, like overnight.
And here's the bottom line. The whole point of the Basel Norms is to build a financial system that's strong enough to take a punch. It's about creating a system that protects your money. And when your money is protected, that promotes a stable economy that benefits everyone. At the end of the day, it's really all about building trust.
So where does all this leave us? Well, the Basel Norms have definitely, without a doubt, made the global banking system safer than it was before 2008. But are we completely safe? Is another huge financial crisis impossible? The thing is, the rules are always sort of playing catch-up with the new risks that pop up. And that's definitely something to think about. Thanks for joining me.